Okay, good afternoon, everyone. You all welcome to the second keynote address of the conference. The speaker is Ayhan Köse from World Bank. Ayhan Hoca is the chief economist of World Bank's Equitable Growth Finance Institutions Vice Presidency and the director of Prospect Groups. Ayhan Hoca was born in Istanbul and raised in Istanbul. He has a PhD from University of Iowa in economics and a BS in industrial engineering in Bilkent University. So I'm going to cut it short as Ayhan Hoca requested. So he's going to talk about global stagflation. Hocam, you have 30 minutes talk and 15 minutes for question and answers. And the floor is yours.
Teşekkürler Yılmaz. Öncelikle Türkçe'ye hitap edeyim arkadaşlara. Değerli arkadaşlar, internet üzerinden bu oturuma katılan arkadaşlar, hepinizi saygı ve sevgiyle selamlıyorum Washington'dan. Tabii konferansta Kapadokya'da olmak sizlerle daha detaylı dünya ekonomisinin karşılaştığı sorunlar üzerine konuşmak isterdim. Fakat buradaki program nedeniyle katılamıyorum. Bugün son zamanlarda gündemde olan bir konu üzerine kısa temel konulara yoğunlaşan bir konuşma yapmak istiyorum. Konu hepinizin bildiği stagflasyon konusu. Konuşmanın geri kalan kısmını İngilizce yapacağım. The idea here is to simply focus on three questions. The first one, why is stagflation a risk today? I think the answer is very simple. You look around the world, you see inflation is elevated and growth is weak. And there's this possibility that we might end up in a period of protracted high inflation combined with weak growth. That's why we are discussing the issue of stagflation. Stagflation does not have a well-defined definition, generally understood as when you have weak growth and high inflation. The second question is, what threat this stagflation present for emerging market and developing economies? Throughout the presentation, I'm going to use this acronym EMDEs that stands for emerging market and developing economies. And what we know, the last time we had this extended period of stagflation, you see that, of course, that translated into a global recession and a string of financial crises in emerging market developing economies. Given the state of these economies now, how they are vulnerable, they might end up seeing the same type of outcome as they saw in the early 80s. And finally, the important policy question, at least nowadays, we are focusing in the World Bank, what policies these countries implement to confront the food and energy price shocks. And there, I'm going to briefly provide a set of policy messages. So let me focus on the first question. Why is stagflation a risk today? And there, the big, of course, challenge when you look at the global economy, at least the external environment, emerging market and developing economies is facing rather complex and extremely challenging. Commodity prices plunged during the pandemic, but then rebounded very strongly. And you can see here in the left panel, it wasn't just because of the war in Ukraine. Even before the war in Ukraine, we saw a sharp increase in commodity prices after April 2020. Now, many of these prices reached their record highs or very close to record highs in the first 2 quarters of this year. And now we saw, at least in the context of agricultural commodities and the metals prices, some moderation over the past 4 weeks. But still, when you look at the natural gas prices, a lot of pressure because of that. Those prices, of course, have been on the rise, even though oil price moderated as well. This supply side shocks associated with commodity prices played an important role in pushing headline inflation up. And this is the similar dynamic that played out actually in the 1970s as well. When you look at the financial conditions around the world for advanced economies, emerging developing economies, you see a serious tightening. The conditions are worse than what we had at the beginning of the pandemic for emerging market developing economies. The third important dimension when we think about emerging developing economies, of course, how trade has been weakening. You can see the trade forecast we have. We are expecting 4% growth in global trade this year after, of course, the record rebound more than 10% last year. And this weakness in all likelihood will continue next year. So what happened to inflation with this external environment? At the beginning of the year, the idea was that the inflation was going to moderate because the supply shocks that we had, they were going to unwind. But of course, the things played out different than what we expected. Inflation at the global level is now running at almost 3-decade high. And in emerging market developing economies, it is 14 years high. And in advanced economies, it's a 4 decades high inflation. In fact, in the case of advanced economies, we have inflation is now close to 9%. This is the highest rate we saw since 1982. Inflation expectations for this year and next year have also increased quite a bit. So we are, at least on the inflation front, see that the challenges are becoming more persistent. You might say that by some measure, we are already in an era of stagflation. If you just think stagflation is a state of high inflation and weak growth. And on the right panel here, you see our growth forecast, and we downgraded our growth forecast significantly. Last year, growth was around 5.7% at the global level. That number this year is around 2.9%. It's like half of the growth rate what we saw last year. That was a record number. But the most important thing, when we released our forecast, it was June. Now, since then, we further downgraded our growth numbers, and I'm going to discuss those very soon. Another important observation, how broad-based growth weakness is. We have inflation around the world, quite visible. But when we look at the growth numbers for this year and next year, there is steady deterioration in forecast. In fact, when we released our forecast, we downgraded growth forecast for more than 70% of countries around the world. In the case of advanced economies, we downgraded more than 85% of them. And the challenge now, given the recent forecast, when you look at the consensus numbers, and you see it here for 2022 and 2023, the picture has gotten much uglier. So in the case of growth, for example, forecast suggested in February for next year, global growth to be around 3.2%. Now, that number was downgraded to 2.3%, even lower than what we expected, of course, in June. And in the case of inflation, you see here on the kind of the right panel, the 2023 evolution of these consensus forecasts. The consensus inflation for at the global level picked up from 2.7% to 4.6%. In the case of inflation as well, wherever you look at, you see countries that target inflation, pretty much inflation is above target. So all advanced economies now inflation higher than their target levels, and in 94% of inflation targeting emerging market developing economies, inflation is above target. There are only two countries actually in the world, emerging market economies, developing economies, Indonesia and Uganda. They have their inflation still below target. Now, how do we think about inflation going forward? Our model-based forecast suggests that inflation is going to peak actually very soon, and then gradually decline to about 3% around the middle of next year. Now, the issue is that even with this 3%, we will be at least 1 percentage point higher than what we had prior to the pandemic. And that's the big challenge. I mean, how central banks can get to the inflation, can bring the inflation to their target levels before losing some credibility and before inflation expectations getting de-anchored. So there is this possibility of having high inflation for a period of time. There is also the possibility of having weak growth for an extended period of time. And if you look through the current, the steep cyclical downturn, long-term growth prospects do not look good. On the left, you see these potential growth estimates by the World Bank. Of course, the fundamental drivers of long-term growth in terms of labor markets, productivity, and investment have all been weakening. So these potential growth forecasts suggest that global potential growth over the 2020s will be 0.6 percentage points lower than what we saw over the 2010s. And on the right, what you see is the expectations of consensus forecasters about long-term growth. These are 10 years ahead growth forecasts. And for the world, long-term forecast of global growth is now 0.7 percentage points less than it was 10 years ago. And for emerging market developing economies, it was almost 2 percentage points lower than what consensus forecasters expected a decade ago. So in a nutshell, you have high inflation, and there is a possibility of high inflation becoming more persistent, above inflation targets, and there is a serious threat of growth remaining weak, especially in 2023 and beyond. So between these two, there is a very serious risk of stagflation confronting the global economy. So let's turn to the second question. Why this is a critical threat for emerging market and developing economies. There, the important benchmark we need to think about is the 1970s. And there are some important similarities with the 1970s and the current period. The steep growth slowdown coupled with high inflation. The last time we basically had this combination at the global level was the 70s and early 80s. Now, when you think about the sharp increase in oil prices and near doubling of food prices recently, you see it on the left how the developments in commodity markets were historical over the past year. The energy price jump we saw was the largest since 1974. The food price index moderated now, but it has gained 60% prior to that over a 2-year period. This is the third largest jump after what we saw in 1974 and 2008. And the same is true for fertilizers, which is quite important when you think about the agricultural production. Now, in the 1970s, these big energy and food price spikes triggered the global recession of 1975. The post-recession rebound, as you see on the right, was also followed by a steep and broad-based growth slowdown, like the one we are experiencing now. So there were these supply shocks hitting the global economy in the 70s. We have similar supply shocks, and we are going through a similar downturn what we had. Of course, the 2020 global economy had a recession, and then you had 1975 global economy had a recession. So another important issue when we think about the 70s and now, in the 1970s, there is this long period of monetary policy accommodation. And what we had in the global economy after the global financial crisis, an exceptional period of low inflation and price stability that came with a long period of monetary policy accommodation with unprecedented, unconventional measures in place, along with very low interest rate. When Olivier Blanchard discussed this issue and talked about the stagflation earlier this year, he also discussed the negative real interest rates in the United States, like what you see in the left chart here. Even if you broaden your horizon beyond the United States, the prolonged period of negative global interest rates is an obvious comparison. You see what happened in 2010 to 21 in the global economy and what happened in the 70s and 80s. Global real inflation rate was negative and pretty much similar. Another important issue, of course, the debt accumulation we had seen over the past decade was very similar to the type of debt accumulation we had in the 70s. Now, there are some important similarities, but at the end, history does not necessarily repeat itself. It only rhymes, to paraphrase Mark Twain. So should we be optimistic about the global economy overcoming the inflation problem and escaping a stagflationary trap? And in that, there are some important differences from the 70s this current conjecture brings. Arguably, the most important difference here is the transformation of monetary policy. In the early 1970s, advanced economy central banks had just exited the Bretton Woods. Emerging market, developing economy central banks were pretty much all peg their exchange rate regimes, the notion that they might be responsible for or even able to affect inflation had not quite gained traction. If anything, they operated along the Cliff's curve, trading off inflation with unemployment. Of course, since then, there has been a complete change. All the major central banks now prioritize price stability. All of them have dramatically improved their transparency, their independence, and their inflation fighting credentials. And that has helped anchor inflation expectations. And you see on the right, even in emerging market developing economies, sensitivity of inflation expectations to inflation surprises has declined quite significantly. Another important difference between the 70s and the current period, we are still in the high inflation period, but outside the United States, price pressures are still mostly in non-core items. Globally, headline inflation is still only half of what it was in the late 1970s, and core inflation is not even 1/4 of what we had during that period. Outside of the United States, wage pressures are also still much weaker than what we saw in the 1970s. Of course, central bankers around the world responding to the inflation shock quite aggressively. Almost half of emerging market developing economy central banks already tightened their monetary policies last year. About 1/4 of them started doing the same in this year. And you see that on the left, there was almost 3 percentage points increase in average policy rates in these economies. For the United States, a much faster adjustment is now expected in interest rates. And after the Jackson Hole meeting, market expectations of policy interest rates for this year and next year shifted upwards as well. In the continental Europe, of course, the ECB signaled its desire to increase interest rates aggressively if necessary. And you see the interest rate expectations shifted. Bank of England was in an exceptional position. It basically signaled that it will continue increasing interest rate even if the economy gets into a protracted period of recession. Now, will this type of aggressive central bank tightening help and overcome the stagflation problem? I think that's the million-dollar question. What you see in the left chart, the cumulative policy rate increases through past tightening cycles. Since Volcker was Fed chairman, he was the one he engineered, of course, the response to inflation in the late 70s, early 80s. But that response triggered the global recession of 1982 and a string of financial crises in the 80s and 90s followed. What you see on the left, you see how high correlation was at the beginning of how high core inflation was at the beginning of the inflation, at the beginning of the tightening cycle. Now, when you look at the current tightening cycle, the level of core inflation probably warrant the much higher, much aggressive policy response from the Fed. But as I showed earlier, markets' expectations of policy interest rate remained lower than the type of aggressive policy response we saw from the Fed. Of course, this is an ex post assessment. When you design policy in real life, you need to take into account incoming data and be constructive as much as possible while signaling your desire to do the additional tightening if necessary. And policymakers have done that in advanced economies around the world. So why stagflation issue is something we really need to worry. In the early 80s, the sharp, aggressive response did bring down inflation. But as I mentioned, it triggered the global recession of 1982. Global per capita GDP fell by more than 1%, and half of the world economies ended up experiencing a recession. And you see on the right, that period was truly a dark era for emerging market developing economies. Number of financial crises, debt crisis, currency crisis, banking crisis were incomparably higher than what these economies experienced in the 70s, 2000s, or 2010s. So this the 70s and 80s era, something policymakers in emerging market developing economies need to pay attention to. Finally, what policies can emerging market developing economies use to confront these food and energy price shocks? Here, the big message is the following, and I'm going to keep this part very short. Policy responses so far have been mostly distortionary. Some countries brought blind subsidies, tax cuts, in some cases price controls, and trade restrictions. What we know from past experience, from basic fundamental economics, these types of policies always and everywhere backfire when you have the type of commodity price shocks we are going through. Fiscal policy needs to be supportive of monetary policy. At the same time, of course, there should be targeted interventions to help most vulnerable groups. But if policymakers need to implement these types of distortionary measures, these types of measures have to come with clear sunset clauses. And we are hoping that the policymakers will sooner or later see the impact of these types of interventions at the global level, because if everybody imposes trade restrictions, everybody imposes subsidies, there is this cumulative effect. And what we know from the earlier food price shocks episodes, that elevates actually the global price of commodities. So let me quickly summarize. I focused on three questions. The first one, why is stagflation a risk today? Why we are discussing the issue of stagflation? There is this material risk. We might end up seeing a protracted period of high inflation and weak growth in the global economy. That's why we are focusing on stagflation. Second, why this is an important threat for emerging market developing economies. The last time we saw stagflation in the global economy, that period ended with a string of financial crises in emerging market developing economies. Given the vulnerabilities these economies have now in terms of current account balances, in terms of debt accumulation, in terms of erosion of policies in some emerging market developing economies, policy frameworks, it's important that global community finds ways to overcome the inflation problem while national policymakers undertake the necessary response and put together credible policy formulation and communicate these clearly, and of course eventually calibrate the policies as business cycles evolve. And finally, what are the important interventions when it comes to emerging market developing economies confronting these food and energy price shocks? And there, the answer is rather clear. They need to avoid distortionary interventions, and they need to think about targeted policies. Let me invite you to check out our publications. During the next 2 weeks, we are going to release a new study about the possibility of a global economy getting into a recession next year with our views on this issue. I'm hoping that you will look at that study as well. Let me thank you again to Yilmaz and conference organizers for giving me an opportunity to talk to you today. Thank you. Yilmaz, back to you.
Now we are going to take the questions. We'll take questions from the audience here, and also if there is any on YouTube channel. So I will start with the audience here. Any questions, comments? Okay, let me ask one question. Belki the audience may come up with some questions. Well, in Turkey, you know, the policy rate is 13%, and you know, credit interest rate is about 25%, and inflation is about 80%. So the real interest rate is negative. So I was wondering if you guys at World Bank ever discussing the policy implementing in Turkey. I mean.
Thank you, Yilmaz. Obviously, in my presentation, I was discussing the state of the global economy, the policy issues confronting the Turkish economy are quite complex, and we have our new country director just appointed, and we have our office in Ankara, economists on the ground talking to authorities, and they are best placed to answer questions about Turkey. I'm focusing today on the global economy. The important point, given this persistent inflationary pressures, both monetary policy and fiscal policy need to play a role. For example, when you look at the United States, central bank has accelerated its tightening cycle, and in all likelihood keep the interest rates going up for the foreseeable future till it sees inflation moderates and stabilizes, and it gets its target level. On the fiscal side, fiscal policy needs to complement monetary policy. At least it's not going to undermine it. But at the same time, when you have this type of sharp changes in prices, you need to think about the implications for vulnerable groups. So fiscal policy needs to have a targeted role in terms of moderating the impact of this large changes in prices on the most vulnerable groups. In many emerging market developing economies, of course, there's this challenge of making sure in an environment external forces are there. I talked about the commodity prices, I talked about financing conditions tightening, I talked about global trade slowing. Policymakers need to calibrate their policies and adjust them. This will require, of course, the type of economic knowledge and understanding, but a little bit of finesse. So we are hoping that they will deliver in those dimensions. Back to you, Mas.
Thank you very much. So I'm turning to the audience again. If you have any question, comments, you can raise your questions in Turkish as well, I guess. We talked to Ayhan Hoca before his talk. Şeyde var mı? Yok. Okay, I think there is no question, hocam. You presented very clearly, this means. Thank you very much for joining us. It was very beautiful, wonderful contribution to our conference. So I'll hope to see you in the future conferences. Thank you very much.
Thank you Yılmaz. Umarım yakında görüşebiliriz. Hepinize iyi konferanslar diliyorum. İyi günler. Sağ olun.
Çok teşekkürler hocam. Hoşça kalın.